Hello, welcome to Geojit Spotlight. This video is on the short-term noise in the market, short-term volatility in the market, and how market participants should respond to this short-term volatility and noise in the market. The stock market is a very noisy market. There are extreme emotions in the market, and market news will become headline news. Stock market up moves, and more importantly, stock market crashes will become headline news. This has always been like that, but in this modern age of electronic media, the noise is several times more than what it was in the past. So today we have fundamental experts, technical experts, chartists, macroeconomists, and a whole host of YouTubers flooding the market with information, lots of information. So how should market participants respond to this flood of market information? How you should respond to this flood of market information will depend on what kind of a market participant you are. If you are a trader in the market, this information may be relevant, technicals may be relevant, may be appropriate. The moving averages will be important, the 20-day moving average, 50-day moving average, 100-day, 200-day moving averages may be relevant. Support and resistance will be relevant. The total volume of transactions in the derivative market will be relevant. Is the market oversold or is it overbought will be relevant. Derivative data like put-call ratio will be hugely relevant. All these are relevant if you are a trader. But if you are a long-term investor, all this data will be totally irrelevant. For instance, now there are lots of anxiety and concerns regarding some major issues plaguing the markets now. For instance, there are questions asked on how long will the Ukraine war last, when will it end? How long will the American Central Bank, Fed, continue tightening the monetary policy? What will be the terminal interest rate? Will this hawkish monetary stance of the Fed push the US economy into a recession? If the US economy tips into a recession, will that lead to a global recession? Will that global recession impact the Indian economy? If so, by how much? Will the North Korean dictator Kim Jong-un send more missiles over Japan? How Japan will respond to this? All these are significant in the short term because it may be having impact on the market. So if you are a trader, all these factors need be considered. But if you are a long-term investor in the market, all these are totally irrelevant information. You don't have any control over these information. So it is better for the long-term investor to completely avoid that. I will explain this in some detail from my experience in the market. I started investing in the market in 83, 84 in a very, very small way. That was a time when the markets were very, very regulated. Not regulated like now, but it was totally a different kind of regulation with manipulation by even the stock exchanges. So when I started investing, the Sensex was around 250. We know the base year of the Sensex is 1979, but the Sensex came into existence only in 1986. So in 1983-84, the Sensex was around 250. So what happened after that? Many major instances happened, many events happened tragedies happened, crisis happened. I'm telling you briefly how this impacted the market or did not impact the market, more importantly, in the long run. Within a few months of my investment in the market, there was a major tragedy in India. Prime Minister Indira Gandhi was assassinated. It led to a lot of political uncertainty and convulsions. Soon the Khalistan movement gathered momentum. It was even feared at that point of time whether Punjab may get separated from India. That was a genuine concern because the movement was very strong. Then we had the Ayodhya issue, the Babri Masjid demolition and the communal riots that followed. Then in 1991, India faced a major balance of payments crisis, a kind of crisis we never experienced after the country became independent. We had to approach the IMF for a loan. We had to pledge gold, sell some gold. Then in 1991 again, the former Prime Minister Rajiv Gandhi was assassinated while electioneering. That created political upheavals. Then we had a serial bomb blast in India in 1993. Even the Bombay Stock Exchange experienced a bomb explosion. Then in 1997, we had the Southeast Asian currency crisis, which roiled the stock markets in Southeast Asia. Indian markets also were impacted, though less than proportionately. Then we had the Kargil war with Pakistan. In between, there were many floods, droughts, and tsunamis, earthquakes, which had serious impact. And also, I forgot to mention that in 1992, we had the Harshad Mehta scam that led to a boom in the market and a spectacular crash also in the market. In 2000, there was another scam, the Harshad Mehta scam. Again in 2000, we had the global tech bubble bursting, sending global markets into a tailspin. Then in 2008, we had the global financial crisis, which led to a major crash in the market. After that, the European debt crisis. And more recently, in 2020, the COVID epidemic, which impacted the market seriously, leading the global economy into a recession. But what happened to the market? I am just telling you about my journey in the market. In the ultimate analysis, what happened? The Sensex moved from 250 to more than 58,000 now. During all these upheavals and problems and crises which I mentioned, the market went through crashes, recoveries, crashes, recoveries. But the long-term trajectory has been up. From 250 in 1984, the Sensex is now about 58,000, delivering a compound annual growth rate of around 15%, beating all other asset classes by a wide margin. So what is the conclusion from this? What is the takeaway from this? If you are a trader in the market, this noise may be relevant because they may be impacting the markets. But if you are a long-term investor, this does not make any sense at all. This is totally irrelevant. Therefore, what you should do? Investors should follow a very simple investment strategy. They should buy high-quality stocks with growth potential. They should continue investing through the mutual fund route, ideally through the systematic investment plan. Remain invested and wait with patience. In other words, ignore the noise. Thank you.